talking about stable coins today. This one article I thought was a good place to kick off the discussion. This article talks about how Tether is making more money than BlackRock, which is really a wild thing to think about. And, in my opinion, stable coins have been one of the most successful things that crypto has pulled off. So I think it's a good time for us to have a discussion about stable coins and really run this down and talk about it in detail.
Absolutely. I think stablecoins is one of the most interesting aspects of crypto. I don't think it is understood by many on the fiat side or the crypto side. We did hear Bobby Kennedy in his speech the other day mention stablecoins in his address to the Bitcoin convention and the possibility of using stablecoins. We've also seen one of my favorite disgraced and forgotten politicians, Paul Ryan, had a clip on some TV show about a month ago, and he was talking about how excited he was about the prospect of getting fiat currencies over to something that looked more like a stable coin. So some politicians are aware of it and moving in that direction. But stablecoins kind of covers a couple of bases. I know we're going to get into algorithmic versus collateralized stablecoins. Where do you want to start digging in, Grant?
Well, let's start by surveying some of the more popular ones, and then we can start talking about the differences. So Tether obviously is the champion of stable coins, followed very closely by Circle and what they've done with USDC. Both of these have launched their stable coins on various different chains. So I think Ethereum was one of the top places where stable coins got launched, largely because there was so much NFT, DeFi stuff that was happening on Ethereum. But largely, these companies have launched their products on a variety of different chains. I think USDC is pretty famous for this, is that they've embraced a lot of different blockchains and issued a stable coin on it. And it's a pretty good mark that you've made it if Circle embraces your chain and issues a stable coin on it. And I think if I'm right, Tether's done this as well. Does that sound right, Lucas, that Tether's on a whole bunch of different chains?
Yes, Tether is on a whole bunch of different chains. We might also mention that Circle, and maybe you'll correct me, but I'm pretty sure this is correct. But Circle is an Andreessen Horowitz venture, is it not?
Well, I know that they had some ties to Coinbase, right?
They do. They do. And I'm pretty sure they're backed by Andreessen Horowitz, which also backed Coinbase and were part of the Coinbase ecosystem, Coinbase being the exchange and Circle providing stable coins and pairs between the various blockchains for that exchange. So, and I think it's important to remember that association behind Circle because of Coinbase's sort of outsized role with regards to seeking the imprimatur of the SEC and bringing crypto into the mainstream and providing sort of reliable solutions for in areas that maybe were operating outside the jurisdiction of the United States and outside the bounds of, I don't know, accepted accounting practices. So just important to remember with regards to Circle. And I prefer USD because of those associations with Circle.
Yeah, so here in the description of Circle, we can see that it's running on 15 different blockchain networks. The thing about stable coins that I think is very interesting to note, especially how they're talking about it, is how is a stable coin different from a CBDC? And largely, these things are very similar. And in fact, the issuance of stable coins really is the precursor or presages central bank digital currencies, because essentially these are private monies. And when we talk about collateralized or algorithmic, we're talking about the way that value is derived for this private money. And this is something that we've talked about, right? That, why do we have like this money that was created by the Fed? Why don't we have private monies? Well, there are private monies, and they've gotten to be very, very popular. And these private monies have some basket of assets or way that they achieve a value. And so with Circle, we've got a one-to-one backing with dollars. Like that's the way that Circle said they're doing it, right? So it's one-to-one redeemable for US dollars. So they have a window where you can go up, you can hand them your USDC, and they will give you back $1 for each USDC that you give them. So there's a window for redeeming this. And when you have an algorithmic stable coin, it does so in a different way. Like it doesn't redeem one-to-one for dollars because it's ostensibly not backed by dollars. It's instead backed by a basket of different assets, and those assets are used as the collateral that backs that stable coin. So the difference between the two is that one has this ability to establish value because it has $1 for each of the coins that's traded, whereas the algorithmic one has some basket of stuff. And I think famously, the one that I remember the most, popular one was this one called UST that was trading on the Terra Luna blockchain. Now there have been a couple other ones. I think Frax was a stable coin that was algorithmic, and it recently switched to being collateralized. So I think that there's actually very few algorithmic stable coins that are left, and almost none that are popular. But that's sort of the basic setup here. Is we've got Tether, we've got USDC, we've got algorithmic versus collateralized, and that's the basic setup for stable coins. And that these private monies are the precursor to how you could actually have some centralized banking entity create its own version of this. And ostensibly, it would be very similar to what Tether and Circle and others have already done, which is they're saying, hey, we have some mechanism whereby we're going to create more of these tokens, or we're going to retire them. And here's why they have value, and here's what the value is. And so that basic setup and premise is a stable coin. And largely this has been used to do a variety of different stuff. And I think you mentioned one thing that was kind of shocking to the world, which was that we had Iran getting around sanctions via Binance to trade oil for Tether. So this is definitely being used out there in the real world for a variety of different things, and starting to be used for more substantive use cases beyond just providing a trading pair on unbanked exchanges, although that was a huge use case as well.
And not only Iran, but also Venezuela. And I bring that up because it's very important for us to remember too that these stable coins and the various ways which they are created are giving the world various options outside of the dollar, the SWIFT payments network, and the traditional ways that they've done business. So we're going to see more and more stable coins. As we're describing stable coins too, I think in part of the stock market and traditional finance. Some people might ask, why stable coins? Why do we need something like that? And if you think about how traditional businesses are structured with or capital, I don't know, capitalized businesses are structured with a stock, that isolates the business and its products from the fluctuations in the value of that company. But whenever we live in a blockchain world where the value of the base token can fluctuate, when Ether can be a couple of $4,000 one day and $2,000 the next, and Bitcoin can be $70,000 one way and $60,000 the next, then people who are engaging in those ecosystems are going to want a variety of focus points to be, setting like what the actual value is and distributing the fluctuations around. And so I think that's what's important to think about, like why we need something like a stable coin to promote the use of a system.
Well, and thinking about where this evolves to, so now that we're hearing the BRICS countries thinking about creating a different payment system and using a digital currency slash blockchain basis to do it, this is exactly what they're going to be mimicking. Like, so the patterns that have been set by Tether and USDC via Circle will be the mechanisms whereby these new payment systems are created and these new rails are used to create alternative currencies. So we're seeing this happening kind of in real time now, that these coin types have been created and they've been very successful. And now that there's need within these other areas to create alternative currency systems, this is what's going to happen in the next few years. Is we're going to see BRICS rise up. We've also seen discussions about how we want to use Bitcoin as the unit of account to create debt. And that creation of debt using Bitcoin as the unit of account will also look a lot like a stable coin or like a alternative currency system, because they're essentially the same thing. You have something that is of value, it backs the thing that you're trading, and then that thing that it's backed for is ultimately the thing that you're redeeming for. It actually looks a lot like gold and silver certificates from long ago, Lucas. I don't know if you're picking up on the parallel there, but like it's that idea that you could go take your one thing and you could go trade it for the thing that actually has value. And that gets into a really deep rabbit hole of like what actually has value, because why would you want a dollar to begin with? Like, what is the point of making that the unit of account? And I think there was a good discussion about this recently about what should be the unit of account for the world, and it's starting to look like Bitcoin might be the unit of account for the world.
I was going to chime in a little bit on this real quick, Lucas. I'll just mention a post I saw that the U.S. national debt, I think it said, is now exceeded $35 trillion. And when I start thinking about that, I mean, it's almost a number unaccountable and unimaginable to me. And when they broke it down, I think it said that there was $130,000 worth of debt for every U.S. citizen in the United States. And to just imagine that, like, just imagine being born and then automatically have $130,000 of debt for the government put up out on your head, and just the amount that it's just going to continue to rise at these inflations if we allow these things to happen.
I mean, the debt is the national debt of the United States is spiraling out of control. Part of one of the problems is the outsized kickback of spreading our currency throughout the rest of the world. Places that as we create more dollars than we then we bring in value from other countries or from ourselves, then this has become a problem. But Grant, you mentioned or you brought up Bitcoin versus gold and silver, and it is very interesting to think that the limited supply of Bitcoin will give us a better metric or a better point to begin to understand how a currency has been inflated. And in we talk a lot about these central banks and that they inflate the amount of currency that they have by, they talk about these targets that they have, 2%, 4%. That's just an imaginary made up number that first we see from Australia's central bank, I believe in the 70s. But even leading into that, part of the narrative that financiers and economists and politicians gave with regards to why they needed a currency that was inflationary was because you could go out and dig gold and silver out of the ground, and you didn't actually know how much it actually existed in the world. And there was some magical percentage of discovery that occurred. So, and which is also interesting, and that's how Bitcoin, with the mining concept and the years that it was introduced out into the world, which are still occurring, is happening. But at some point, we reach a fixed amount of supply, and I think that will be a much better measure, better financial instrument for international financial instrument for countries to base their currencies and their exchange rates off for the various countries. And as for our national debt, Rusty, who knows what we are going to be doing there? We've seen other countries begin to understand that amount of inflation and stop buying treasury bills and treasury bonds and the other products that the Treasury puts out. I forget what the third time window is. But
it just goes into me of thinking, if the United States has such a huge debt of its own, then what is the real value and in strength of the U.S. dollar? I mean, it's my kind of a point of view. Like, the strength of a country is what you can do for yourself, and the strength of what the America has been able to do for itself financially has been terrible the last couple of years with the way that things have been going. And I don't know if there's a way that we could ever dig our way out of it in any efficient way. I think the numbers are just going to keep on going on, and people are just going to be like, well, it's already so far lost that what's another $30 trillion in 5 years? I mean, what's it really going to make a difference?
Well, we talk a lot too about taxes, the amount of taxes that we have in countries, and we started with this conversation with a mention of ETFs and this notion that you can have baskets of various assets that you put into consideration for what you base a currency off of. And it's one thing to talk about gold and silver, and that gives, when you're trying to set up an exchange between various countries so that they can figure out, what currency is owed for what currency, it was useful to use some sort of asset that everyone had a piece of, gold and silver, and now Bitcoin. But in reality, the debt that is accumulated by those countries is an offset of the taxes or the tariffs that they are collecting, the taxes that they're collecting from their citizens and the tariffs that they're collecting from other countries. So, and going back to the debt that we hold in the United States, interestingly enough, we hold a lot of it ourselves. So, if I tell you that I'm gonna loan you $40 and I'm gonna borrow it from myself in the future, and I do that and I write a note and I say, here's $40 and here you go, Rusty, you can go spend that in the world. That works as long as everybody believes it. But,
yeah, I mean, it worked pretty good in Dumb and Dumber too, while they had a brief case for the IOUs. But when the guy came to collect, I mean, it really didn't look so funny and enjoyable.
Well, Lamborghini, you better hold on to that one.
Well, speaking of the money supply, as far as that made up number, if we go just by looking at something like the M2, and I don't know if you want to clarify the different terminology, M2 versus M4, it was a pretty stable line up until 2010 or whatever that is on the graph there. 2020 right here. So up until 2020 and COVID, and then it just stuff got maddeningly crazy, right? I think this line is like what the Fed has traditionally tried to hold, whatever this is, like 2 or 3% inflation of the supply, which is insidious and terrible. And don't get me wrong, I think this is awful. But like this is where just it got nutty. And I think that this is where we're currently sitting. And this is why we're starting to contemplate other currencies and certain nations saying, you can't do this. Like once you've done this, you've gone off the rails here, and we're no longer interested in your currency. But the fact of the matter is most stable coins are pegged to this thing here. Like that's what's happened. So for there to be an alternative unit of account, you've got to be willing to trade in some other denomination. And this is where BRICS and Bitcoin and all the rest of this are starting to move towards, because it's essentially a barter system, right? I mean, there's nothing fundamentally different than that. It's like you have some cows, I have some gold. I'm willing to trade you cows for gold because you know that if you get the gold, you can go turn around and you can trade gold for whatever else. Gold was a good unit of account. It was hard to get, and it was universally accepted. Bitcoin sure as hell looks like that at this point. It's hard to get, it's universally accepted, and almost everybody is willing to trade for it. Currently, we still price Bitcoin in dollars, but I think there's going to be a day where we just start to price things in Bitcoin, and Bitcoin will be tradable to US dollars for people that want to retire their contracts and their debts, which were denominated in dollars. But that'll probably be the last few things that happens as people are starting to settle up their accounts when they're forced to.
That's I will call that the day that we flip the denominator. And I do think it will be Bitcoin rather than dollars that we flip the denominator to. You bring up M2 versus M4, and these are measures of the money supply, and I think it's very important to understand them. You also talk about trades, and I mentioned these specie baskets that we base currencies off of. Well, and you talked about cows for gold, but what about like you're next to a country that has a long shoreline and has fish, and you live in a landlocked country that has wheat and a lot of farmland. Well, you can also imagine saying 1 bushel of wheat equal 5 herring, or 1 bushel of rye equals 7 herring, and having multiple commodity swapped agreements that that denominate or that say what the value in various commodities are against each other. And so that's another metric that you can begin to build a money system off of. But going to M2, M3, M4, M5, M0, these are different ways of measuring the actual money that exists, because when you start actually talking about money, if you have a house that's worth that you paid $19,000 for in 1971, and here we sit in 2024, and you're 85 years old, is that house worth $19,000, or is it worth some magical number more? Is that number based off of like what you've paid taxes, or what it's been assessed to be, or what you go out and actually price that on the market as?
I think it has to be that the currency is worth less. There's no other way to look at that, right? Shelter is worth what it's worth, and land is worth what it's worth. And unless there's some substantive thing that causes devaluation of it, which can occur, right? I mean, I think you're seeing this in Florida right now. I don't know if you're tracking, but like there's a tremendous amount of supply of real estate that's become available in Florida because of a couple of different factors, right? They've had a lot of natural disasters roll through, hurricanes and floods and a variety of stuff. And it's really hard to insure property in Florida now. Additionally, there is some speculation that if the seas rise due to melting ice, which some have speculated will happen, then Florida could find itself with a shrinking coastline, and a lot of the property that's near to the coast would then be no longer habitable, or it would be flooded with seawater. So you're starting to see a devaluation of property, and barring that kind of a event, shelter and land are pretty stable. Like it farmland produces a certain amount and it's worth a certain amount. A home provides shelter, and so it's worth a certain amount. And so if you look at the price of things in a different type of commodity, you use a different kind of an account, then prices look stable, right? I think if you price a house in bars of gold, it's been pretty stable for a long period of time because houses and gold have gone relatively the same direction, which is they're stable to each other, but they're rising in price against US dollars. And that's because the US dollar is doing what we've got on the screen right now. It's debasing, it's going down in value, and it was going down at a fixed rate, which if you want to keep people spending, that's the thing you want to do. You want to keep the money flowing. So you don't want an appreciating currency as far as, the market theory goes. But, as far as is your $19,000 house worth, $1.5 million now, barring weird market forces, causing exuberant demand shock or something like that, or supply shock, then it should be pretty stable with respect to the correct unit of account. And I think when you do that, shelter looks pretty stable.
Well, it does in some methods, but part of the reason that I was pointing out these different measurements for measuring the amount of money out there is because this also has a very real consideration with how currencies are managed, how governments manage currencies. In 2009, whenever the TARP program was rolled out to bail out to provide liquidity to banks and to businesses in the United States, it was done so by making massive loans to banks and telling these banks, like, this is part of your capital reserve. And it was also, I mean, when we say, like, how did the Federal Reserve, like, create that money? Well, it had assets on its balance sheet. It had, like, the Mall of America in Ohio. And what does it do? To magically create money immediately when it needs to do something like that. You just say, well, all these assets, this Mall of America was worth $3 trillion yesterday. It's worth $4 trillion today. Voila. There's $1 trillion. Now let's give that $1 trillion to a bank and tell them that they have to hold on to that money and put it in their capital reserves, and they can't lend it out for a certain amount of time. And that way they can control the prices by slowly releasing money into the economy. And part of the reason that we saw a massive rise in price inflation coming out of COVID is because in the response to COVID, instead of giving money to banks and other financial institutions and managing the rate in which that money was released into the hands of consumers, we put money directly into the hands of consumers. And that led to consumers, running to Amazon and running to the internet and their local Walmart and Sam's Club or whatever, and buying things that the moment they got a chance to. And so then we became trapped in this narrative of the supply, the supply lines being broken, but in reality, what had happened was a lot of money had been created and put directly into the hands of consumers, and they all ran to the grocery store and everywhere else to spend that all at once.
Well, and it also reminds me of the fact that banks really operate as, investment vehicles, right? And what you're talking about when you say, well, they have these assets on the balance sheet and they said they were worth a certain amount. We're starting to see similar types of situations with a broad swath of banks in the United States, where it's been speculated that a lot of the assets that are being held as collateral for the loans that have been put out are improperly priced. And this is no different than like what Trump got in trouble for in New York City, where he said, hey, my properties are worth this amount. And then in one place he said, hey, my properties are worth this amount. And the whole thing was about improperly pricing it on various different things and giving a different price in different places. Where he wanted to minimize tax, he was saying, hey, the property is worth less. And where he wanted to maximize value for loans, he was saying it was worth something else, and saying that that inconsistency is what led to him getting into trouble. And it's likely what's going to result in a lot of the banks in the United States getting into trouble, because they have a lot of commercial real estate that is currently sitting on their books. And if they did what's called mark to market, they would have to mark down those assets so substantially, because commercial real estate is just selling at fire sale prices. Like, it's in some places selling, 20 cents on the dollar, 10 cents on the dollar in some places, because there just is not this demand for commercial real estate with everybody working from home. So this idea that you have collateral and it backs debt, and debt is how the money supply is increased, is what an algorithmic stablecoin is. So to tie that back to our topic for today, it's, well, what does it even mean to have an algorithmic stablecoin? Well, it means that you have a basket of different stuff. It's not one-to-one backed. You're not saying this is redeemable for gold. It's not like a gold or a silver certificate where you go to the bank and you say, pay the bearer on demand 1 ounce of gold, and this piece of paper is effectively trades the same as 1 ounce of gold. That's what a collateralized one-to-one like circle looks like. When you have this algorithmic thing, then it looks more like your bank. Your bank is lending, it's doing all kinds of stuff. It has assets on the books, and that's how it establishes value, and it should be generating a return on investment, which is paid to you in the interest rate that you get for parking your money there. They put your money to work, and they've done all this stuff, and all of these things, ostensibly, they've done it in a way that's not risky and is very safe and is generating a safe rate of return, and that's the interest rate that you get. So this can fantastically fail in very unobvious ways when the investments go south, and that's why a lot of the algorithmic stable coins have blown up. UST, the one that was done on the Luna blockchain, famously did this and just got destroyed, because the idea of doing an algorithmic stablecoin had a flaw in it. So if you have a flaw in the way that you're setting up this stablecoin, or if you have a flaw in the way that the bank has set up its investments, then it can catastrophically fail. And many are speculating that that's exactly the situation that we're facing with a lot of U.S. and community banks.
Absolutely. And it was mark to market accounting or considerations that led to the collapse of Silicon Valley Bank, because they had taken on a lot of debt obligations that were coming due. Actually, it's too far back in the past for me to remember too many of the details, but that was exactly that sort of a lack of appreciation of the value of assets that the bank had lent money on that led to the collapse of Silicon Valley Bank and First Republic, both. And I think that part of that was in the wake of the collapse of FTX. Some of those were digital or were assets that were part of the crypto or tech sphere. But either way, I think it's interesting to correlate, stable coins to how banks do business. And we talk a lot too about currencies, about CBDCs, about the Federal Reserve monetizing debt. But in reality, it is the banks that are under the national system of banks that do so. And we also don't. That are actually creating money, because whenever a bank issues a loan to anyone for a house, for a car, for a small business, they're actually creating money. And that's also why it's important to go back and look at how we measure money with regards to the different money supplies in 1 and 2 and 3 and 4.
It's a really good point. And it's a point that's lost for those that don't have a firm grasp on what fractionalized lending means, right? When you have the ability of a bank to take in some amount on deposit and loan out more than it has on deposit, that ratio is the amount of money that it's allowed to create. And when you think about how the money flows within an ecosystem, right? If I get a $50,000 money that was created from debt from you going to your bank, and then I take that $50,000 and I go to some other bank and make a deposit, and then they loan it out. I mean, you can really see how the money supply can increase substantially based on this one little rule that says a bank can loan out 5x or 10x the amount it has on deposit. That you can see that that is an exponential that's kind of shocking when you really start to do the math on it.
Absolutely, and I mean, I put a link over, by the way, to a Wall Street on Parade article about the FDIC. You know, and one of in some way, the way that this system that we currently have is bound together, I don't know, intra bank stablecoin asset is FDI and is insurance, federal insurance. And I believe at the end of last year, the FDIC had a couple $100 billion in reserve against trillions and trillions of dollars in liabilities from the first or from only the top 5 banks or the 5 largest banks that exist. And when
FDIC insurance is starting to look like a complete and utter scam. There's no way that they can cover the banking sector if we were to have some kind of systemic shock. There's just no chance. And this, to me, again, says why Bitcoin? Because of this. Because your money is not safe in the banks. I think for what we saw in Silicon Valley, the government had to step in and help with that. Because it was collapsing in real time, and it could have had a ripple effect on a lot of other stuff. And there was a fear that something was going to happen, that the banking sector was going to go down like that. And so if we see a lot of this mark to market and we have a lot of trouble with the banks, you could see small community banks just kind of folding up and saying, well, there's not enough money at FDIC to guarantee your money, and so you just lose it. Like, sorry, you got wiped out. Like that happened. Your bank folded.
There's also part of this which I think is interesting. In the wake of Silicon Valley Bank, the Federal Reserve actually moved employees into into the structure of the largest banks because they needed to provide liquidity and make sure that none of the other banks failed. And not only that, I believe it was First Republic, but I forget which bank later failed in that year, and the FDIC seized the bank on a I believe a Tuesday, which is remarkable because the FDIC used to wait until the end of the week, and they would seize the bank on a Friday. They would go in and take an accounting of the assets, the liabilities, everything else, and auction that off to other institutions so that they could open the bank up on Monday and proceed with business as normal, and everybody's covered. Well, let's not forget that the Silicon Valley Bank also made whole the assets of everybody without consideration to the thresholds for which FDIC insurance is limited to.
Well, they kind of had to, because their customers largely were these companies that were getting investment from Silicon Valley VCs, and most of them were getting a lot more than $250,000, which is starting to look like a paltry sum in today's world, right? With the inflation that's happened of the dollar, $250,000 doesn't look like a ton of money. Although, for the average, American citizen who doesn't have couldn't put their hands on $1,000 in a time of need, it might as well be the moon. But for certain other types of individuals that exist in what is the new upper middle class, whatever, $250,000 is not that much money. So it depends who you are particularly, but FDIC does not look like it can meet its obligations, and therefore a lot of what we've got in the banking system is faith, right? It's just a belief that none of this stuff is going to go belly up. But even in the wake of the Silicon Valley Bank collapse, it was said to a lot of the startup companies and companies that have gotten VC money, you need to hold X amount of Bitcoin so that in the worst case scenario that you can't put your hands on your money fast enough, that you still have the ability to make payroll, make your obligations, and Bitcoin being the way that they said to do this, to hold a certain amount of their treasury in Bitcoin.
Not a vote of confidence for them to be hawking Bitcoin in such a way. But we can see too, like, I always talk about capitalism as the true definition of capitalism is, does a government allow an institution to fail? And it certainly didn't in the case of Silicon Valley Bank. And this is part of the reason that we see an inflation of the amount of dollars, because they're unwilling to allow these financial institutions to fail. Rusty, you also brought up, what do we make in America recently too? What do we make? We have an outsized financial system. We don't make anything here. We pass money around and we pay off the people who pass the money, which goes back to the original structure of the creation of the national banking system, in which the original design in 1863 was that the banks got paid in gold and everybody else got paid in paper. And we see the problems that's created today. But let's turn back to stablecoins.
Yeah, let's go back to just kind of a couple more things that have been happening in the world. So there was one other major algorithmic stablecoin that existed, which was Frax, and FRX USD voted to stop being algorithmic. And I think one of the reasons why a lot of the algorithmic stablecoins don't really last that long is there's just way too much correlation in the crypto markets. When Bitcoin rips, everything rips. When Bitcoin goes down, everything goes down. That tends to be the way that it is. And there's reasons for this correlation, but the fact is that for you to create an algorithmic stablecoin, you have to have a basket of assets that don't perform the same. And that's really key, because if everything goes down at the same time, there's no way for you to rebalance your portfolio. You can't say, well, I want to hold some of this and some of that. Some things are going up, some things are going down. And when we rebalance, we're back to having something that has a fixed and stable value, because everything is going down in a correlated fashion. There's nothing to retreat to. Especially if you're the stable coin, like that's usually what people are retreating to. Like if crypto is going down, to be like, well, I'm going to sell before it goes down so I can buy back when it goes low and I can make money on these trades and what have you. So if the entire market is very correlated and everything goes down pretty much at the same time, then algorithmic stable coins really can't work. Like they don't function. And I think that's why we've seen this idea of an algorithmic stablecoin sort of not really play out, because the crypto markets are way too correlated and they all follow Bitcoin.
But I do think there will be a future in algorithmics, and in fact, I think algorithmic stablecoins are the future. But what we have not had was enough of assets that were accounted for in blockchain or in some manner for the stablecoin to rely on.
I mean, you could definitely contemplate doing some kind of an algorithmic stablecoin with a basket of commodities. You could have the stablecoin which trades wheat and sheep and lumber and whatever. It's like you could have something like that. But the idea of creating crypto-based algorithmic stablecoins was that they would not have a custodial risk, particularly, right? Other than the custodial risk that is all of the coins that are controlled by the smart contract. There's definitely nuance there, because if you go digging under the covers of how these things worked, they sure look like custodial risk regardless, right? Because a lot of the assets were held either in single sig wallets controlled by centralized entities or in multi-sig wallets controlled by centralized entities. And when you have that, you really haven't gotten away from a custodial risk, period. So the only way to sort of do something that looks kind of algorithmic, that doesn't carry a custodial risk, is to do everything on chain, which I've only seen one stable coin that even comes close to doing that, and that's Circuit DAO on Chia, right? So when they launch their product, then that will be an algorithmic looking stable coin based on debt that I think very much is what Bitcoin hopes to do someday, but that we're going to get a chance to see, Circuit DAO sort of playing out in real time. And the reason they're able to pull it off without a custodial risk is they have a smart contract language that allows them to create the sort of product that they're interested in. So if the chain has the right power on it as far as its programmability, then you can pull it off. But otherwise, you never get away from this custodial problem that exists, either between Tether and Circle and whatever other companies are using collateralized stablecoin. You have to trust the custodian.
Somebody put a question to me the other day after one of the Trump speeches, in which he floated the names of Jamie Dimon and Larry Fink as possible picks for his Secretary of the Treasury, and asked which would I prefer. I said Larry Fink, and I say that because whenever Larry Fink talks about crypto and he talks about what Blackwater actually does, BlackRock actually does, it is basically this. They're the type of bank that puts together these currencies, or these little baskets of assets, and then sets up a financial instrument on top of them so that people can quote unquote make money while minimizing the possibility of losing it. So I think that we're going to see massive interest and a move of traditional companies into this realm, and I think we're going to see many stablecoins coming in the future. The other side.
Well, can we talk about this for a minute? Because I think that
go ahead.
This one is really interesting, and I think, again, the reason something like this can be done this way is because Chia has a smart contract programming language that allows you to do something pretty substantive. So this pattern, I think, is what the folks in the Bitcoin world are hoping that they'll be able to do someday. And it's not currently possible because Bitcoin script doesn't allow it to happen. But essentially, what is set up here is you take a certain amount of the base layer token, so that's Chia in this case, and you trap it into a certain type of contract. And when you trap it into that contract, you allow for the creation of money based on that backed asset. And so the backed asset price really underpins the entire thing. So if Chia is trading at $20, then fine, you can borrow a certain amount. But if Chia precipitously drops and its price goes down, then your collateral asset is worth less, and therefore your borrow is potentially at risk. You might have to put some more collateral in. You might have to top it up with some additional Chia, or you might have to just straight up pay off the loan to avoid getting your collateral liquidated. And that's essentially how these debt borrowing product stablecoin things look. So unlike fractional banking, which if we were to draw a similar diagram like this for a bank, instead of saying, hey, you have to give me, a certain amount of collateral and you can borrow 40% against it or 60% against it, the banks in the US invert that, and any fractionalized bank inverts that, and they say, well, we can take X amount of collateral and we're going to borrow out 5x the value of that asset. So it's really crazy to think that there's no mechanism in the banks to actually call all that money in. This is the classic bank run, right? If everybody came in and demanded their deposits, there wouldn't be any money at the bank because it's all loaned out. Not only is it all loaned out, but it's loaned out in a way that the collateral cannot be recovered. So, this is where this whole FDIC thought comes in, because instead of liquidating the collateral, which is what happens in the blockchain, because there's no legal proceedings, there's no way to sort of go hold people to account other than to take the thing which has been borrowed against. And so that's what the liquidation is in a scenario like this, where you've borrowed against an asset. If the asset prices falls, or if you fail to make payments on your loan, then your collateral is collected, it's sold off, and then everything is settled up accordingly. So this it hasn't quite launched yet, but is an interesting way to do a stable coin. It very much looks like a private money, and it should be interesting to see how this plays out on the Chia blockchain.
Traditional banks do have something somewhat akin to it, and they are their stress tests. But I was surprised to see, again, going back to Silicon Valley Bank, in the wake of that collapse, the stress tests that they had been subjected to were at a 2% interest rate. And that was less than what the base Federal Reserve rate was, or the bargain window at the Federal Reserve was. So again, this is why it's important to get government out of banking, because they don't want anyone to fail, or they don't want to be seen as responsible for those failures. I think we should also talk about Tether and why I'm at least more akin to be excited about an algorithmic stablecoin than a collateralized stablecoin. Tether is the largest player. We started with the valuation of Tether. But Tether has had a complicated, checkered history with regards to how they are backing their stablecoin. I'm not sure of the timeline, but Tether has not submitted to a full audit, and they've only done 2 attestations. And when they did so, they moved the ostensible collateralization that they had for their Tether coins into a bank account for a day, and had that the value of the dollars in that bank account recorded, and then in one case, I think they paid off $500 million to creditors, and who knows what happened to the rest of the money. But just as we see problems with how the government is regulating banks, and the expectations that they have of what the interest rates are, or the values of the assets are in banks, private institutions do worse if they don't do better. And so I think we need to see algorithmic stablecoins that work, because it's expectations of collateralized coins to continue to perform. I think we're going to see failures. And I would say that the only reason that Tether, or the only reason that we see collateralized stablecoins working now is because people need them, and so they want to believe that they work. So, hot take for the end of the show. Anything else that we want to, or go ahead, Russ.
Speaking of that it is the end of the show, I just want to mention real quick that we do have a special guest tomorrow, and I don't know if you guys want to spend a few minutes just warming that up, or letting people know how tomorrow's going to go.
Well, stay on topic for 1 second, and we'll put this article in the description of the show. So if you are catching this on YouTube and you're curious about Tether and what we sort of opened up, there has been a lot of talk about Tether not having an appropriate amount of assets to back the amount of USDT that they've created. So not only do we have the Fed printing dollars, but there have been allegations that Tether has been doing the exact same thing, and that's partly how they've been able to make the amount of substantive gains they have, is that they really don't have the assets to back what they've been doing. This has been theorized for quite some time. Many have speculated that Tether was going to go down because of this, and it really hasn't panned out. So we'll see what happens in the future, especially if we start to see, centralized entities creating competitors to things like Tether. If the US dollar ever becomes digital in a way that would be a strong competitor to USDT or USDC, then you could easily see something like Tether wane in its popularity if people would rather go straight to the source to get their digital currency. But yeah, I'll throw this one on here as like a last thing. You can read up on it. This one's an older article from 2021. Like I said, this has been speculated for a long time, and it really hasn't panned out yet. So we'll see if that happens.